Thank you everyone for coming today. I know I've mentioned this last time. This is going to be the last time we're meeting, at least for a month. We'll see if we can do one online. We can just meet, answer questions, talk about any topics. If you have any questions about setting up the portfolios from today, feel free to message me. We can go over that maybe online during the call. So we'll see how it goes. I'll see how my schedule is going to be. If you guys want to meet, Alex, if you want to organize the meeting for everyone while I'm out, let's talk and see where we can do it. Maybe here at Tanya's place. But you can all meet and talk about investments and questions. And we're going to start the lesson today as always we do now. We'll start with two things that we are grateful for. So if you can take the notepads, your pens or phones, and you put two things that you're grateful for the past week. Let's start with that. Let's think what happened in the past week that you're grateful for. Okay, and the next question is, what stuck with you the most from the last lesson? So the question for everyone is, who opened up a Robinhood account or any type of investment account from the last lesson? One? Okay, a few of you. And who have set up an automatic purchases of S&P 500? Anyone? No? Almost? Okay, well hopefully after today we'll do it and we'll have a little bit something happening, reoccurring on a frequent basis every week or every month. I'll show you how we're going to structure the portfolio and I'll explain why we would structure it that way. And you can always customize it to your liking, but that would be the first step. So what stuck with you most from the last class? Anyone wants to share?
It's super easy.
Okay, so investing or starting to invest is very easy. Right, I think that one lesson is very important. Starting to invest is very easy. And today we're going to talk about when to buy. We're going to talk a lot about portfolios. We'll talk about balanced portfolios, what makes a portfolio balanced, why would we want to have a balanced portfolio. And then I have created something that I called Pro Groshi portfolio for all of us, just to have some kind of starting foundation for anybody who is not sure where to start, how to invest, how to structure the portfolio. This would be basically the first step to do it. You can take it or leave it, but I think it's going to be very helpful based on everything we're going to discuss later. What I do want to share is that if you missed only 10 best stock market days, your returns will drop by approximately 50%. So if you've been investing for 20 years and you've been trying to trade, maybe you've been trying to time the market, if you missed just 10 days, so if you multiply 20 years by 365 days, it's approximately 7,500 days. If you missed only 10 of them, your return would be 50% less. I went and actually found those 10 days. A lot of them happened recently. So you might say, well, 20 years ago, I couldn't have started investing, right? But there was actually 4 of those days were in 2008, during the financial crisis. So a lot of people, their natural tendency when things go bad, we want to save our money, we want to take them out of the market, and we want to leave them as cash. But what happens is usually the worst days, they're followed by the best days. And if you take your money out, and you miss that one of those best days, your returns are going to be much less than average. So you're much worse off taking your money out. The same thing happened during 2020 when COVID started. We have 3 days that were during 2020. And then we have one in 2025, right? When April happened, when tariffs were happening, everybody were panicking. No one knew what's going to happen with the economies and everything. People started to take their money out of the markets. One of those next days, April 9th, we've had almost 10% return during one single day. So if you're taking your money in and out of the stock market, you might be losing one of the best opportunities to actually increase your savings and retirement. Another fun fact is that, I'll just remind this, we kind of spoke about this, I think 3 lessons ago or 2 lessons ago. Investing $100 monthly from age of 20 to 30, and then stopping the contributions but leaving the money to work and be invested in the market. Over time, it's going to beat an amount that you would get if you were investing $100 monthly for 30 years from 30 to 60. So going back, here I'm talking about the compounding effect. So if you start early and you invest, you will get so much further ahead. Then you wait, you accumulate cash, you try to save money, you try to save enough to invest, that if you do that, you're most likely going to have less of returns if you just start today. So if you start today putting $10 into S&P 500, you're going to be much better off than trying to wait another 5 years before you have $1,000 or $2,000. Over 40% of S&P 500 returns come from dividends reinvested. So again, if you're buying S&P 500, but your dividends that you get from all these stocks, you keep them as cash, right? So for example, you buy one stock of S&P, which is about $600 today, and you get a dividend from that. You get a dividend redistribution because it's an ETF. So you get, let's say, I think it's about like 1.5% quarterly. So you get about $7, $8 from one stock of S&P. If you keep it as cash, that's fine. But you're missing out on the opportunity to make money from that dividend. Because when you put it back into S&P, you will get a little bit more dividends next time. So again, you're kind of kicking in this compounding effect. When you get money and you reinvest them back, you will get more money on dividends because you've reinvested the previous dividends. Since 1925, we've had 15 recessions, 1 Great Depression, 1 World War, countless crises, and the market is still at all-time highs. So again, I'm just trying to show you that, as from the last lesson, it's very easy to start. I've explained on last lesson the platforms, right? The Robinhood and other platforms, they allow you to buy fractional shares. You don't have to wait until you have $600 to invest and buy one S&P 500 stock. You don't need to wait. You can put $10. You can put $15, $20 today and already start getting dividends. I actually didn't address this last time, and nobody asked, and I didn't think of it. It's like, well, if I buy 0.3, let's say percent, 0.3 of one ETF, of one S&P 500 share, how would dividends work? Am I going to get dividends if I buy fractional shares? And they do. I checked with Robinhood. They will just give you the fraction of the dividend. So if you buy $20 worth of S&P 500, instead of getting full amount on dividend, you will get 5 cents, 6 cents, whatever that number is, but you will still capture it. And the more you buy, the more you're going to get from the dividends, and then more you're going to reinvest. With Robinhood, it's very easy. A lot of platforms allow you to do that. So don't wait. Start investing as early as you can. So going to when to buy, things really depend on your goals. I can't tell every one of you to invest all of your money, because it really depends on what you're trying to get to, right? It's like, what are you saving your money for is important. So that goes back to the question of what your goals are. If you're trying to buy a house or you're trying to start a business, then you need cash. You can't use stocks in order to buy houses. You can't use that to start your business. So if you know your goals and you know how much you need for your goals, the rest that you don't need, you can invest. So what I'm talking about is liquidity. If you need liquidity, if you need cash, then don't invest that cash. Use that cash for whatever reasons. But otherwise, when to buy? Pretty much always. Yes, that goes to the dollar cost averaging. And I think for the most of you in the room, always is a good rule. We don't know what kind of war is going to happen. We don't know how much the stocks are going to drop. But what we know statistically is that if you stay invested and as early as you can get into investing and staying in the market, you will most likely increase your amount of contributions that you've put in. You will preserve your money, you will preserve your cash, and you will multiply it. It's really the easiest, though. This is something for me that I like to think about, is that when I invest into stocks, for me it's the easiest way to participate in the business creation. Because when I buy a share, that means that I'm kind of like voting that that business is going to succeed. If I like going to Starbucks and I like their coffee and I like their ambience and their interior designs, I'll invest in Starbucks and I'll basically let them know that I appreciate their services. I'm going to participate in their business creation. That's how I look at the investments, right? I like to feel like I'm part of the company that I'm investing into. So if I'm doing angel investments or public market investments, I'm looking at it from the perspective of what businesses do I like, what businesses would I want to be a co-founder of, and I buy those shares. Yes, I don't have any voting rights, but that's fine with me. I'm sure there are smarter people who know the industries much better, and they can make much better decisions. So right now, what I want you to do, this is going to be our first attempt. I want every one of you to get pieces of paper or your phones and try to sketch what can your portfolio look like, purely on intuition. If you don't know any companies or stock names or anything about what the portfolio can be, how much percentage, that's fine. Purely on your intuition, spend the next 4 minutes to try to sketch, to draw, to write down what your portfolio can look like.
How many points?
How many what?
Points.
How many points? Totally up to you. Totally up to you.
How many shares?
It's all up to you. So pretend that whatever amount of money you have, it doesn't matter, because what we are talking about is 100%. 100% of all your funds, everything that you have, where would you put that money? What would your portfolio look like? Is it cash? Is it crypto? Is it stocks? Is it real estate? Is it bonds? Is it cars? Is it watches? Anything you want, anything you can think of. Everything into the lottery, 100% of it, whatever you feel like you want your portfolio to have. So there was one question, can you buy less than one full share on Robinhood? Because some platforms like Charles Schwab, I think maybe Interactive Brokers, a lot of platforms don't allow you to buy 0.2 of a full share. So with Robinhood, you can put as little as like $10, $5 into S&P 500. So you can buy 0.0002 of S&P 500.
You can also do it with IDR.
Oh, you can do with Interactive? Okay. So Interactive Brokers and Robinhood, you can do that. Okay, who got their portfolios ready? Good. Anybody else? Nice. Who wants to share their portfolio with all of us? Yes, please.
I want to buy something in military industry.
Okay.
Gold.
Gold.
Bitcoins.
Bitcoin.
Like toys.
To-
Company.
Toys?
Yeah.
What kind of toys?
Company.
Oh, Toys R Us? Or
I think it's a few of them.
okay. Like collectibles.
Because I saw some, you can find some company and they can produce toys.
Right. Got it. Okay. Nice. What else?
Something in technology.
Technology, yeah.
And AI.
AI. Okay. So a lot of stocks, and you said gold as well, right? Okay. Good. Bitcoin. Right. Anybody else who wants to share their portfolio? Please.
It sounds similar, but just number one, crypto.
Crypto?
It's not insert Bitcoin, but number one, startup stocks, like some are on the early stage.
Private equity, basically.
Like investigation. And then number three, unicorn stock.
Unicorn companies, okay.
That nature.
Okay, nice.
Number four, gold.
Gold, okay. Did you put any percentages on how much do you want each of them?
No, it's up to my discussion.
Okay, okay. Thank you so much. Ryan, did you want to share?
I mean, I have my portfolio that is under management.
Yeah.
My advisor, but
Yeah.
I can just share. So it's like 90% of ETFs.
Okay.
It's yes, high technologies, commodities, what is it? It's Turkey national stocks.
Okay. So international.
Right? Interesting. And some gold and cash.
Gold and cash. Okay.
A little bit crypto, just a little bit.
Got it. Okay. Thank you. So this was just for every one of us, the first kind of like attempt to build our portfolios, to see how much would we allocate to gold, to stocks, to bonds. I think a lot of us do it like intuitively or based on the information that we heard from other people. So today I will try to give you a little bit more tools on how to look at your portfolio and how to make those decisions. But before I do that, this is a good question. What did you think about when you were trying to build those portfolios? Right, so yeah.
So I thought about my experience and about my past.
Okay.
So what exactly I have done.
Yeah.
So, and unfortunately, I think that it influenced me
Mm-hmm.
in good and bad way. For
Yeah.
example, I can share maybe it's interesting for someone else. So approximately 5 or 4 years ago,
Mm-hmm.
probably 5. A lot of my friends, they decided together and to create a group in Kyiv. And maybe you have heard about this theory, $10 bucket theory.
$10 Buffett theory. Okay.
Yes. So
What is it?
so the main idea is like when you just invest $10 each day,
Mm-hmm.
like every day
Mhm.
you should do it like without any excuses, anything. So
Okay.
what we did, we actually we just had one, not manager, but like
Somebody who made decisions.
yeah. No, we made decisions all together, but just one person who was responsible for money and
Yep.
for all this kind of stuff. So what we just once a month, I just it depended on quantity of days per month.
Right. Right.
So I just sent money there, and actually I already have we have this special group chat, and each month we discuss our activity
Yep.
and everything. So after so many years, I can tell that even I actually can check how many years
It's okay.
passed because of I know how. So it was like approximately 15,000 or something.
Mm-hmm.
So and it was like $10 every
Right,
day.
right.
Like, you know,
It adds up.
I
Yeah.
even didn't thought about that. So the main idea is that it was just crypto.
Yeah.
So and now we decided to start all over. So we just sold all that money, and it's like 3 times.
Okay. Nice.
Yeah.
So you've invested a lot into crypto, and you've got 3 times of your return.
I invested just this $10 every day.
Okay. So-
I didn't take any decision. I didn't want to think about
Right.
it. I had a guy who was clever and like.
That's amazing. So when you were trying to build your portfolio now,
Yes.
what you were thinking about your past experience, and you saw what worked for you there, and you were basically doing similar allocation, and you
I
said,
didn't put any crypto in my
no, okay.
in my portfolio. That's the point, and it's strange. So I didn't put, for example, I didn't put real estate. I didn't put
Right.
any real estate.
Okay.
I already invested in it in Ukraine.
Right.
And I cannot tell right now that it was a good decision from this point.
Right, right, of course.
Yeah, but I definitely try this stocks.
Yeah. Anybody else? What did you think about when you were trying to draw the portfolio allocations?
I mean, future.
Future? Okay. What about the future?
I mean, you have something, you have some pillow, financial
Mhm.
stuff. It's kind of you feel much easier.
Right.
Yeah.
Okay. Anybody else? One last person. When you say, for example, I want to put 30% of my money into gold, 30% of it into crypto, and 40% of it into stocks, right? what happened? Like, how do you assign those percentages? What should you think about?
Diversity.
Balance, diversity. First, you should think about your objective. It's like, why am I doing this? Why should I put this much into this specific asset? And we will see that different assets have different probability of return and different risk assigned to them. So what I want you to do now, to write down one more thing. I want you to write down one very clear objective for yourself. Something that you want to achieve with investments. So if you're thinking about investments, what is one thing that you want to achieve with it? Do you want to get a great retirement with a lot of money? Do you want to buy your first house? Do you want to put your child into the university? Do you want to buy a yacht? Do you want to build a business? To use that, what is it? One thing. I would just want every one of you to write one thing that you want to save money and invest them into to achieve this goal. Passive income. What does that mean?
I mean, if I have some budget in the stocks, maybe I get some every month, like dividends.
So you can use those to pay for your lifestyle. Okay.
Buy a couple of houses.
What is it?
Buy a couple of houses.
Buy a couple of houses. Okay. What is it? Early pension. Okay.
Business.
Business. Open your business. Nice. What is it? Stability. Okay. Who is done writing their one goal? Some of you shared. I just want to see if everybody is done. Okay. This is mine. Put kids through school, right? One of those. There's a lot. But here's a question for all of you. Did you do a SMART goal? How many of you remember what SMART goals are? Right. So some of you said, I want passive income, I want stability, I want to open my business. But with the SMART goals, we need to be very specific. We need to be measurable, achievable, relevant, and time-bound. So let's try to do it one more time. Let's try to create a SMART goal with our investment. Go back to your papers and add these 5 things to your goal. So if you want to open the business, what kind of business? How much money do you need to open the business? Rough estimate. When do you want to open it? You can write why is it relevant to you, but I would imagine that you have those ideas. So make it very specific. Make it smart. Make your goal smart. Same with passive income. How much do you need, right? By when? Do you need it in 5 years, in 10, 15? What is the time that you have to achieve that?
Whole life.
Whole life, okay.
And my kids, for me.
Okay.
Whole life.
Do you think it's achievable?
Maybe not.
Make a new goal, the one that's smart.
Like in this year, I want to have like 5,000.
5,000, yeah.
For open my business as artist for like art gallery myself. And
Nice. In San Francisco?
Yeah. No,
Here.
Yeah.
Or where? Yeah. Okay. Put it down.
What's relevant?
Relevant, it means it's relevant to you. Like why is it important to you? Because you can say, well, I want to buy something, right? But is it really important? Is it your goal? Is it just because you've heard somebody do it? And So it's relevant to you. It's very personal to you. I'll give you another minute and a half to do a SMART goal, because I think it's important. To have a goal defined very well first is very important. Because in order to build the portfolio, you need to have a good objective. And if you're done with one and you still have time, write a second one. Okay, so moving on. This is the one that I've got for myself. So put 2 or 3 kids through school and university. I will need $2.5 to $3.5 million by the end of 2050, totaling about $125,000 each year. right? So that is my very measurable, very time-bound, very specific, very relevant goal. And I hope that you can create yours. And the next time you're asked to create a goal, or you wake up and you think of creating a goal, I didn't expect that to be taken a photo. When you wake up and you think of like, okay, what am I doing, with my life? What am I doing with my money? What am I doing with my time? You can put the goal, and that goal is SMART. It's specific, measurable, achievable, relevant, and time-bound. So now we get to the question, what is the investment? What is it? Well, it really is an instrument to close the gap. And I found this graph, and I liked it a lot. And if I had a whiteboard, I would draw it from the beginning. But here I'm just going to show you the result. And the idea is that you have money, how much cash you have or need, and the time in years or your age. When you begin your life, you need to spend very little, right? Hopefully, let's say your parents took care of you, and this is how much money you need to survive. You need some food, you need clothes. Who pays that? That's a different question. But you don't make any money. Then as the time progresses, you make more, and you spend less. So now you get this period of time before your retirement, when hopefully, if you manage your money well, you make more money than you spend. But then at some point, you want to retire, or maybe something happens to your job or whatnot, and you start getting old. You're going to be earning much less, but nobody's going to be paying for your expenses. The spend still is up there. And yes, it might go down at some point. Hopefully it doesn't have to, right, if you make the right decisions. But basically what you're trying to do with your investments is you're trying to close this gap. You're trying to make sure you have enough money when you will need them for your life, for your expenses. And so there's different ways to approach your portfolio. There are these three things that I want to introduce today during the lesson. They're not conclusive, right? They're not only these three things, but I found them to be a great instruments to look at your portfolios. And so the first thing is to minimize standard deviation. And I will explain each one of them with analogies and in details. But what you're trying to do here is when we are looking at the portfolio, at everything that you have as an investment, you have stocks, you have real estate, whatever, you get a volatility of that portfolio. Volatility means that how much does a unit of asset that you've purchased, let's say Bitcoin, we always hear that Bitcoin is much more volatile, right? It's more volatile than stocks. What that means is that from the day today to the day tomorrow, the price can jump a significant amount compared to something else. So compared in this case, we compare a lot of times to the market, to S&P 500. We see how much does S&P 500 every day fluctuates, and then we compare that measure to how much does Bitcoin fluctuate. I think we have. Can somebody let Igor in? Alex. So we look at this volatility, right? And we look at the volatility inside of the portfolio. And what we want to do, so the standard deviation is volatility. What we want to do is we want to minimize it. We want to make volatility as little as possible because usually we are very emotional human beings. And what happens when prices change rapidly, we make wrong decisions. We either want to sell to get a lot of money because we've just made 15% in a day, or if it goes too fast, it falls rapidly, so the volatility is high, we want to sell to preserve whatever is left, right? So we make that wrong decision. So the higher volatility in your account, the harder it is going to be to make the right decisions. So we want to minimize that. We want to maximize something that's called Sharpe ratio. And I will explain what this is pretty much with this sentence, but also in some formulas and analogies. But we want to maximize the return while minimizing the volatility. So we want to buy something that is not going to be volatile, but it will produce a pretty good return. Because we can say, if I have cash, it is not volatile at all. If I have $10 today, I still have $10 tomorrow in terms of this specific value, right? What it can buy for you can change, so inflation and everything. But the $10 just stay $10. They never change. However, they don't produce you any income, so your Sharpe ratio is 0, right? So what you want to do is you want to find this balance. You can buy crypto, again. It might have a pretty high upside, but a lot of volatility. So your Sharpe ratio is going to show that correlation. It will show you how much you can make, but also how much volatility is going to be. So much, to put it in other words, is like how much stress do you need to live through to get to a good return, right? So the higher Sharpe ratio, that means you will get more return, more profit, and you won't have a lot of stress. And the last thing is beta. We don't really try to minimize or maximize it, but we can track it. So when we have our portfolio, we can track the beta. And we do that to understand if this whole thing was worth it. And what I mean by that is that there's such a thing as a beta of the market. So S&P 500, it has its beta. And the beta is really just the comparison of how much do we move up or down compared to something else, in this case, the market. So again, if our beta is too big, but our returns are 7%, just the same as S&P 500, then why are we doing all of this? We can just put all of our money into S&P 500 and have 0 beta. We will just participate in the market because we're not making any progress, but we are taking a lot of volatility, we are taking a lot of ups and downs. We have to make a lot of decisions which might lead us to miss out on opportunities and sell when we shouldn't. So I'm going to put this into analogy of ocean and boats and water. So the standard deviation, it's basically like a choppiness of the water. How much waves is in the water? A lake that doesn't have any waves, right? There's no wind, no nothing. The water is very still, has 0 standard deviation. Any single wave is exactly the same as any other, right? So it doesn't, like the surface of the water is all flat. It doesn't change from one point to another. When you have big wave, it means that here and here, the surface of the water, here's the difference. This is how tall the wave is, right? So this is a standard deviation of this water surface. So what happens here is, imagine we're on a boat in the ocean, and calm water is low volatility, right? So there's no volatility, no ups and downs. And like an ocean waves is a pretty high volatility. So if we want to use our boat to get from point A to point B, we want to go across the lake, which lake would we choose? The one that has low volatility, no waves, or the one that has really big waves? Most likely we're going to choose the one that doesn't have any waves, because it's much more predictable. We don't need to spend much energy, or as much as we would need to go up and down. And we don't need to use any specific tools, any specific resources in order to overcome potential crashes of our boat. So if the lake is low volatility, that's pretty good for us. So the lower standard deviation, better it is for us. The next thing is Sharpe ratio. I guess I had a couple of, okay, I'll show them after. So the Sharpe ratio, again, it shows how far we move forward versus how hard it is for us to move forward. So this is this, it's not just one thing that checks how big is the wave, right? What it does, it shows how far can we go and not incur any damage, or where do we spend less resources but go further. So again, with this one, we're trying to cross a lake, and the two things that matter for us is how fast we are moving forward, but also how much is our boat is rocking side to side, like how much risk are we taking here? Are we going into like a really big waves and we're trying to get across the lake? We're taking on a lot of risk. So this is what the Sharpe ratio shows us, is how much forward progress do we make and how much risk are we taking. And then here's a formula for it. So the Sharpe ratio is return. This is what we get from the stock market, for example, or from real estate, minus the risk-free rate. What is this risk-free rate? Who knows what the risk-free rate is? Anyone?
Cash?
No? So risk-free rate in the world, we usually use the US bonds, right? So the US bonds, they right now in the world offer us risk-free rate. Because when we put our money into the US bonds, it hasn't been the case yet. We hope it won't be the case. But the US has never defaulted on its debt. So what we say here is the US has a very good credit score. And those of you who read the news can maybe you've heard of that the US credit rating went down, right? It was AAA, it was beautiful, amazing. Now it's AA. Still pretty good, still has never defaulted, but it might. And so what we use is risk-free rate. So this number changes based on the central bank interest rate, right? So based on the interest rate, we can calculate how much we can get from the bonds and everything. And we use our return because, again, why would we want to incur any volatility, any stress, any concerns about our investments when we can just buy the US bonds and get a very predictable return, right? So if you put in $1,000 today and you get 4% back, so you will get $40 in a year from now, or whatever that bond is, maybe 20 years from now. But you know that for sure because, again, the US has never defaulted. So what you do is you take return minus this risk-free rate, and you divide it by the standard deviation, by the volatility. Is how much risk are you incurring? And then the beta. The beta is basically this comparison again, right? So this is not a specific measure, it's the comparison. And it's a comparison of how our boat reacts to the same waves compared to somebody else's boat. So now we have two boats on a lake. It's pretty rocky lake, like it has a lot of waves. And so we are on our boat, looking at somebody else's boat, and we see what happens if beta is 1 for that boat. It means that that boat goes exactly with the waves. So imagine the boat has turned off the engines, and the waves just take it. And the wave goes from this point A to point B. So eventually we're going to cross the lake with no engine or anything, just by using the waves, right? But now if we want to say, well, we've got there first, or we've got there second, or we didn't get there at all, we can use beta to compare ourselves to that boat. And the way we do here is basically if the beta is more than 1, it means that it was rocking us much harder because we were trying to get there much faster. We were incurring a lot more risk. If it's less than 1, we were much more stable. We were taking some precautions. Maybe we were like, I don't know, using some type of tools that makes the boats much less rocky. If it's 0, we just stayed flat. Maybe we stayed on the beach. We never went into the lake. Maybe we flew above the lake and we've never incurred the waves. But we basically, we almost like we can't really compare to that other boat because we never really achieved our goal. And we've never been impacted by these waves at all. And then if it's a negative beta, it means we actually went the other direction, right? We tried to beat the waves and we've never actually made it through. So I'm going to go back to standard deviation here and actually put it into a little bit of perspective. So again, I really like this graph here. What it shows is this. So this is the return, right? So we have 0 here. We don't have any, it's 0% return. So what it means is that if I put $100 into something, I don't get anything back, right? So it's 0% return, nothing happened. And here's the standard deviation. So again, if it's 0 standard deviation, there is no volatility, there is no return, nothing has happened, $100 is still $100. And then we have 100% standard deviation. So cash is 0% standard deviation, but it has some return, right? So if somebody gives us $100, we've made $100. We didn't incur any volatility. There's no volatility. There's no deviation. It's just the $100. This one is very interesting. It doesn't say what it is. But that's actually buying a lottery ticket. So nobody bought their lotteries in portfolio, but you can, right? You can allocate $10 a month and buy some lottery. Your expected return is usually 100% loss. You buy a lottery ticket and you lose all the money. You never win. The standard deviation of it is almost 0. If you do win one time, wow, you've got a huge volatility there. But it almost never happens. So it's really close to here. So the standard deviation is almost always you lose money, right? That's how often it goes. It goes that much often that the standard deviation is very low. Then this one is interesting. It took me a little bit of time to actually get a hang of. It's a coin flip. So if I take a coin and I ask you to bet some money. Let's say you're betting $100 on whether it's going to be heads or tails, right? Just name some, heads or tails. I'm going to flip. Sorry, Alexei.
Okay.
Орел или решка? That's all I'm asking. There's no right answer.
Okay, решка.
Okay, flipping the coin, it's tails. It's a different one. You lost your money. Okay, try it again.
Again, решка.
Okay, I'm flipping the coin. Yes, that's correct. You get your money back. So what happened right now, and we can keep doing it, but what happened is you lost 50% of the time, and you also made money 50% of the time. So it doesn't matter how many times we do this, you will basically stay at where you started. You will never make money with me flipping a coin and you playing this game. But what happens during this game is that from one coin toss, so the first time you flip the coin, all of a sudden from $100, you lost everything. So your volatility is 100%. From $0, so from $100, or like let's say $200, you went all the way to zero, you lost everything. Then you tried to, you came, you found some more money from somewhere. You bet again, and all of a sudden you won 100%. Then you beat again, you lose 100%. You beat again, you win. So with the fair coin flip, the one that is 50-50 chances, right? The standard deviation is 100%, but your return is 0. You don't make any money from this game. And that's where this is the interesting part starts. So our bonds, or American bonds, are here. They don't really have a lot of volatility, but they still have some. The percentage return changes, and there is still risk involved, right? So we might still not really make this much money, but here's also the return, and it's whatever the percentage of the return of the bond. So bond is safer and allows us a little bit of a return. This is ETFs, right? They're very safe because they're extremely diversified, but they allow us less return than stocks. Then we get the stocks, we get real estate. Returns are usually higher in real estate, but there is also more volatility. It's just how it happens is that if we want more return, we usually take more risk. Then we have commodities, we have private equity, and then we have venture capital funds, right? Venture capital funds are usually extreme, amazing return, but the reality is that 9 out of 10 deals in VC world, they fail completely. So this is what standard deviation is, and then I found this a little bit better graph. So again, it shows here bonds, it shows here stocks, this is your return, and this is your risk. And what happens when you buy just the bonds, you're here on your portfolio. So you can calculate what's your standard deviation, what's your return. This is bonds portfolio, this is the stocks only portfolio. But then what if you buy two things in your portfolio? If you start mix and match them, they have different standard deviation, right? So what happens here is you start moving along this line of the return to the risk ratio. So if you have more bonds and less stocks, you're here. If you have 50-50, if you have 25-75, so you kind of keep moving along this axis. This is what happens when you have two things in your portfolio. When you buy more things into your portfolio, it starts to shift this graph a little bit left. And we can see it here as well. It's not just straight line, it has a little bit of a, it's called Pareto ranking. Like you can't really go over it, you can be somewhere below it. So the more things you add to your portfolio, the more you shift it. But also you might sometimes incur more risk with it, right? And so you start to see this frontier that you can't really get over. You just gotta get comfortable with it. And you gotta know where on this frontier you want to be, where this dot you want to be. Okay, are there any questions on this so far? Looks pretty cool, huh?
So I have a question. So if we have like diversified portfolio, we have less risk?
That's the idea.
Okay. And then less return.
That's the idea.
What's the point then if it's less return?
Because it's less risk as well. You know the phrase? Those who don't risk, don't drink champagne.
Okay.
Те, кто не рискует, не пьют шампанское.
No, profit is плата за твой риск.
A profit is what?
Плата за риск.
Yes. Yes, of course. Yeah. This shows us how we can minimize it a little bit.
What is your strategy?
What?
What is your strategy?
We will talk about that. Okay, what I did want to mention here, which is very interesting, and I find it, a little bit fascinating, but it's that the markets are interconnected. I like to give this example, and I'll give you more examples on this. I really like to give this example is when there's a helicopter on the ground, right? And for some reason you're holding on to the bars of this helicopter, right? So the bars that are on the floor, on the ground, and the helicopter starts to rise. And as it's rising, you're trying to calculate how much of a distance it is to the ground and whether it's safe for you to release it and jump and still be alive, or is it not safe anymore? But what happens is you're trying to calculate that while the helicopter is moving up. So by the time you've finished your calculations and you think it's safe, the inputs have changed. By the time you think it's safe, now you have to recalculate again because you're higher off the ground. So what happens is you're stuck. You're stuck in this indecisive moment where you can't make a decision because by the time you make it, it's too late. And it's kind of similar with the markets. When we try to analyze the markets and we participate in the markets, well, have we accounted for our participation in the markets when we were trying to analyze them in the first place? Because our participation impacts the market, right? So on the market, we can't really know what's going to happen with the market. And I have a pretty good video to show that. Who knows this bridge in London? It was called Millennium Bridge. And what happened is it was a very expensive bridge they built in 2000s, 2002 or 3. And when they opened it, people went onto this bridge and it was supposed to be extremely safe. And it's true, it's very safe. But what happens is that when a lot of people come in here, it starts to sway from one side to another. Right? It doesn't collapse, but it makes it extremely uncomfortable to walk on. And the reason why it's uncomfortable is because you can't make a step without being in sync with everybody else. If you try to pause or you try to walk in a different frame of a step, you will fall down because the bridge under you walks. You might have also seen this video, I didn't include it here, but the video of metronometers, you know those musical tools that just tick and tack, right? When you put it on 2 cans of Coca-Cola or something, they start to synchronize. It's exactly the same thing here. If you are out of sync, you're falling off, or like you're falling down on the ground. So you have to walk in step with everyone, and that's sometimes what happens on the stock market as well. That's what happened in 2008, when all the banks are participating in the market, trying to get on these real estate deals and everything. Because if they don't, they lose, they fall on the ground, but they know eventually the bridge is going to collapse anyways. So all they are left with is just keep walking on this bridge that they know will collapse at some point. Unless they can get off of it, but we with the markets, we can't. So that does happen sometimes. Okay, here's another graph to show you how cool the returns from the stock market are. So this red line is an S&P 500, and it's really from like 2010, I think. And these are 4 different types of bonds, right? So these are the bond returns if you put $10,000 into them in 2010, and this is S&P 500. So you would triple your money by about 2024. This is another graph to show you the annual real total returns from the S&P 500. So after every year, we plot what's the percentage return of S&P 500, and you can see that during since 1970, there was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. There was 14 years in the past 55 that you would get a negative return. Here's the kicker, is that you would still get dividends. You would still reinvest the dividends when it's down. So you would ideally buy even more shares. And then you could still be buying while it's down, so your dollar cost averaging. So after 55 years, you are incredibly up high in the profits. Even if in one specific year, it might seem like it's a collapse. Even if it's 2 years in a row, it might seem like it's freaking shit show. Why have I ever invested in my stocks? Even if it's 3 years in a row, it will still most likely get back. Sure, we can talk a lot about geopolitics and US dominance in the world, etc. I'm not going to talk about that right now. I'll still talk a little bit about it later. But always returning back to your objective, knowing your objective well, managing your liquidity if you need money soon, it all can dictate what kind of portfolio you can build. Okay? Also knowing your emotional and emotional intelligence, how much of a volatility can you survive? When you put in $100,000 and the next day you wake up and there's only 40,000 left, what are you going to be doing? Are you going to be putting another $50,000 in, or are you going to be taking the $40,000 out? Right? So knowing your emotions and how they will play into your investments is also very important. I liked this chart. So this is the average investor kind of portfolio. 65% equities, 25% bonds, a little bit of cash. This is a wealthy investor portfolio, right? So we are looking here at public equities, the bonds, the cash, similar things. But then we also add commodities, private equity. So this is the early stage startup investments through private funds. Real estate, venture capital. This is a more later stage, more riskier investments. Hedge funds, private credit, and some other ones like art and cars and things like that. So here's the thing though. This might look like it's a really cool portfolio because there's more going on there, etc. Still, 50% of it consists from just these three things that you already have. And that means that from a whole $50 million account, that person particularly has almost $25 million invested into just this. So my lesson here is that unless we already have $20 million to play with, we might just be better off sticking to something simple that works, that has much less volatility, so that we don't put all of our money into venture capital or private equity or even real estate, because that might just not work. It might have a lot of volatility. You might need a lot more resources to cover expenses, etc., etc. So when you're beginning, this is an incredible place to start. You will also see, I put this here, the US endowment funds. This is for the pension plans and stuff, right? Or like every university has endowment funds. So their purpose is to generate cash, like passive income, to pay for pension or to pay for student grants in universities. They have something similar to these investors here. But again, it takes a whole team to manage. It takes a lot of risk that you need to navigate and control. So we are almost always much better off sticking to something simple. Start simple and then only add more layers, okay? All right, so there's a lot of different types of portfolio types allocations. We're going to talk a little bit about some. So the very, very simple one is one fund. You put all your money into S&P 500. You don't worry about the bonds. You don't do anything. You just put it into S&P 500. Again, it could be a pretty good return, but the risk is a little bit higher. So if you need money next year for your real estate, and the next year is one of these years, right, and you lost 35% of all your money, now you don't have enough for down payment, that might not be a smart decision to put it all into S&P 500. So the next thing you can do is to put it into two funds, where there's an S&P 500 and the bonds. Then you can add the third fund, maybe it's commodities. And so what you do is you create this equilibrium of the return and the risk that you want to take. There is a couple funds that are more interesting, I think. There's a target fund or target date funds. What they do is they basically look at when will you need money, right? So if you will need money at 2050, well, right now you can take more risk, because you still have 25 years to make up for this loss. So again, let's take this example. This year you invest $10,000 into the fund, and we will need this money in 2050. So if it goes down, if S&P 500 goes down, and you lose 15% of that, that's fine. You still have 24 years to make up that loss. So you can rebalance, you can refinance, maybe you can put even more money, and you can make up the loss. But then closer you get to 2050, what's going to happen with these funds is they will rebalance themselves. So what they do is they move some assets, some cash from a riskier investment into less riskier one, into more cash, into more commodities, more into the bonds. Commodities are pretty risky as well. And then there's an age-based rule. It's this one. So the rule of 100 is, that's we usually tend to think is the age that we live to. It's usually more around 80 years, so you can make it even more conservative. But if you plan to live until 100 years old, you can use this rule. So what you do is you take 100 minus your current age, and that's how much percentage of a portfolio you can allocate into stocks. And then the rest goes into the bonds. That way you can kind of like basically take this target date fund and build it towards your 100-year anniversary. Other things to consider for when you are trying to build a portfolio, it's your age, the level of income. So if you have a lot of income today, and you still have a lot of years to go, you might be much riskier today than later, right? So when you have more money, you can gamble a little bit more. You can invest a little bit more into riskier assets, because if you lose, you can still earn more to cover the losses. Your goals, risk tolerance, all of that should go into consideration of your portfolio. So now I have prepared a few examples. And all the names are random. So I used ChatGPT to generate this. And if some of you have been with the group for long enough, you might remember this website, this tool. If there are any errors in this tool, let me know. I've built it, so if there are any errors, I can fix them. But so far, it has been working very well. And so what we're going to do is we are going to actually use a few of these personas to see what exactly is happening with the portfolios. And so here, annual income of Dmitro is $90,000. Can you all see? Should I try to increase it a little bit? The current age is 24, and the retirement age is 65. And during the retirement, we are going to be spending $50,000. So what I do with this retirement expenses is, as you can see here, it's in today's dollars. So what I do is from this year on, I actually, here this full table of the breakdown, what happens with every single number on this page, you can see that the expenses, they start from, we'll see the expenses in a second. But then when you get to your retirement age, it's not actually $50,000. Okay, let me finish putting things in, and we'll see it in much better ways. So it's California. We have to account for tax. We are filling status single. We don't have any dependents. Monthly expenses is $3,500. So what I've done here is I've actually split the expenses, but just for the sake of this exercise, I'm going to show as a full month's expense, right? So there's only 1 month. It's $3,500. Let's see, anything else? Okay. So here, it will show you a full breakdown of all your taxes that you need to pay, or any credits that you might get. So this is how much monthly tax you will pay as Dmitro. This is total annual tax that you will pay. So almost $30,000 in California. And so here you can see monthly taxes, total monthly expenses, monthly income after taxes and expenses. So Dmitro here, he is saving $1,700 every month. This is now for the annual, right? So annual $21,000. So let's go back and see our investments. So taxable account with the initial balance, $10,000, $750 monthly contribution, 8% return, and then dividends is 1.5%. I calculate dividends as a reinvested dividends. And there's a dividend tax rate and capital gains tax rates. These are applied when you actually withdraw money, okay? So again, if we go back to the table for a second, we are going to see this. So these are the expenses for this year, 42,000, and then I take an inflation-based approach. So at the very end, you can see the inflation percentage, and default is 2%, and you can actually change it for any given year, right? So you can say, no, this year it was really bad, it's going to be 5% inflation. But let's assume 2% inflation for all these years. You will see that the expenses, they go up, 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 up until our age of 65, when our pension starts. And our expense is not $50,000 as we said here, it's actually $112,000 because now it's adjusted for the inflation for the next 41 years that we lived on this planet. And you can see it keeps expanding, okay? Well, okay, the best thing about this whole website is this. I hope it works. Okay, perfect. So you can see this chart. The blue line is the total balance of your account, right? And because Dmitro has a lot of years to live, it's almost invisible what happens in the first 40, 50 years. But he starts to invest very early, of age of 24, and he goes on investing until the retirement age. So this red line is the retirement. Total contributions, you can't even see them here because they're pretty tiny. But then the annual expenses are also small. But if you hover over, you can see the actual numbers. And what I'm going to do is I'm actually going to change the age just so that we can see what we are working with here. So these are the three different lines here. And so what happens here with this jump is because our expenses while we are young are smaller than the $50,000 expenses that will come. So if I were to put an actual expenses as we have today, $42,000, then that line is going to even out. It will be exactly even line because now the inflation and our expenses are even, right? So what happens here is that total balance of all accounts is going up until retirement, and then it just starts to go down because we need that money to cover our expenses. And you can see the total contributions here is how much we've actually invested versus how much we've made. So this 2 points between the green one and the blue one is how much we've made money from investments. Okay? So in case of Dmitro, he's doing very well. He has never spent more money than he made in his retirement. That's why his account, and this is a beautiful graph that I was supposed to draw for compounding interest, for when we were talking about the compounding rule, it just keeps going up, and the further you go, it gets much and much more exponential. Okay, well now, let's take a look at another account. So this time we have $160,000 in income. I will close this for now. 35 years of age. 65 is retirement, $90,000. It's still California. They are filing married jointly, and they have one dependent. So for one dependent, we get $2,000 back from federal government. Thank you very much. Monthly expenses are $7,000. And if you put here on this website, if you put more expenses than you can afford, it will give you the warning. It will say exactly how much more you're spending per month than you actually make, right? So it will take this amount from total, from additional total monthly tax amount. Okay, so it will take your income, annual income, decrease the taxes, and decrease this multiplied by 12, and you will see how much you're short on every year or every month. But let's say we are actually spending wisely, and we are spending $7,000. And we already have $40,000 invested. And then we put $1,500, and it's 7% and 2%. So now, well, what we can see is that everything is going pretty well until retirement, right? So by the time we are in retirement as a family, we've saved up $2.8 million, and our annual expenses are only $160-something thousand. We have invested $540,000, so we've made $2.3 million just on the investments. And remember, this is just S&P 500, right? So I'm putting the 7% return and 2% dividend, which is S&P 500 here. So by investing into S&P 500, by 2055, which is 30 years from now, you will have $2.8 million in your investment accounts from just $540,000 investments. Well, okay, but we still have a problem. By the age of 91, we're out of money. So we don't have any money left, but we're still living on this earth and we still need to pay bills. So what happens here, and you can do this for yourself, you can play with really two numbers. I mean, of course you can play with many more. You can either make your expenses in retirement less. So now, by the time you're 103 years, you're most likely good, right? The reason why I made it 120 years, can you see it? Yeah. So you can see that it goes up until 120 years, because that's the age I plan to live to. So I want to make sure I have enough money until then. But here's another thing. If you still want to spend $90,000, or let's say even $100,000, let's increase our retirement age by just 5 years to 70. All of a sudden, we get to the point where we'll never spend our money until we die, right? So whatever is the difference, you can save it for your children, you can leave it to them. If you work for just yet another 5 years, you will basically never run out of money, okay? Also, another number you can play with is how much you put in monthly. So you can see that monthly they make $2,200, but only put in $1,500. Okay, well, let's put $2,200. Boom, now we are again up in the green. But now, let's do this. Let's pretend we waited for 2 years before investing. You want to wait 3 years? You'll be out of money by 95, 4. But if you wait 5 years, you're out of money almost 10 years earlier. So every single year you wait, you almost cut off 2 years of your retirement.
Why nobody is talking about those who die early?
That's another option. You can always diversify your risk by simply dying early. Does anybody wants to do their numbers? I'll send the link and you can do it at home. Okay? Well, let's talk about different types of risks. When I asked ChatGPT to give me different types of risks I can manage with diversification, I got a whopping 43 different types of risks. I didn't know there are so many risks in this life. But here are some that I found the most important. And it's the ones that are in bold, right? So when we diversify our accounts, what do we do? Well, first of all, we diversify across asset classes. We spoke a lot about this today. We spoke a lot about risk and return. When we invest into a little bit more, we can move that risk a little bit to the left and we can get a little bit more return. We can also diversify across geographies. So when we invest domestically versus international, across sectors, right? Somebody knows technology better. Somebody thinks the medical industry is incredibly important. Somebody thinks that Walmart and McDonald's are the best things there, right? Because they're inflation hedged. If the prices go up, people still need to eat, right? Across time, the way we diversify across time is we use dollar cost averaging, actually. We also can rebalance. We can do the lump sum, or we can do phases, right? Across currencies, there's a currency risks, of course. Especially if we invest into international markets, usually these are not hedged by the currency. So if I'm investing into India, in the Indian ETF, and the rupee goes down, then my ETF goes down. So you can hedge. That's where the word hedge comes in. You can basically short rupee. You can borrow rupee from somebody and you can sell it, right? So you kind of like in debt for rupees. But if rupee goes down, then it's cheaper for you to buy back and give it back. So your debt goes down. Remember when we were talking about why it's really good to actually get the debt for your real estate? Is because over time that debt is getting cheaper and cheaper to satisfy, to maintain, right? So it gets riskier buying real estate, but also is better because your debt goes lower. Across investment styles, so you can do different styles. We spoke a lot about that as well. Different account types. And I'm gonna make another point, I'll come back to different account types, but it's important because taxes are a bitch. They take a lot of our returns. If we need to rebalance, that's where I'm gonna come back to this. If we need to rebalance and we're doing it in a taxable account, we have to pay taxes on that shit. So the best way, if you want to rebalance often, you open a Roth IRA or Roth 401k. Across risk levels, so you might be more comfortable with the high risk, you might be not so much comfortable with the high risk, so you go lower. Liquidity and the purpose and goals. I think those two last ones are also incredibly important. Over diversification. If you ask Warren Buffett or Charlie Munger, not anymore, but if you ask them about why Berkshire Hathaway only has 15, 20 companies, why don't they buy more? Why do they have so much cash? They have so much opportunity. They have so much available capital, but they don't diversify into 50 companies, 100 companies. Well, because over diversifying, then you have to remember about managing this whole thing. You have to pay more taxes on every single transaction. So over diversifying is also bad because your returns are also might be just so small, where you've over-diversified, you brought the risk as much down as possible, but your return is also lower. So be mindful of that. Sometimes people abandon diversification because they get into FOMO. They have pretty good portfolio and then Bitcoin shows up. And they're like, yes, 100% into Bitcoin. It's very volatile, right? So we already spoke about this. So sometimes you get FOMO. Sometimes you get, sorry?
What is FOMO?
Fear of missing out. So sometimes you see everybody's making money on Bitcoin, you're like, I want that as well. Recency bias, we spoke about that on the class 4 as well. When something just happened recently, you might be judging or valuing it much more, right? So if you've made 3 times your money on crypto, you might want to put even more because holy shit, it's printing money. But there's statistics, there's risks, there's volatility, there's all of that still in place, and it might just not happen next year. So risk of abandoning diversification, where markets go crazy, we spoke about that. If you keep investing and reinvesting, using those times to accumulate more, when you use dividends to buy more, that will just even out things and make you even richer. Mistakes with portfolios, all in crypto, all in tech stocks, too much home country bias, lack of rebalancing, or lack of liquidity. There's many, many more, but you just want to be mindful. When you look at your portfolio, you want to remember your goal and see if your portfolio is servicing that goal. Is it making you closer to that goal or further away? When I was preparing for this class, I had this realization. I was watching a lot of videos, I was reading a lot of materials about different math, different how the hedge funds manage their risk, how do they diversify, how the portfolios are made, how the Warren Buffett looks at the portfolio. I realized that a lot of them talk about slightly different things. And I've found basically 3 things that we think of when we talk about the investments. Here are only 2. The third one is trading. I didn't include trading here because I think that's pretty much a full-time job. It's not really an investment, right? So if you want to trade things, it can be very profitable, but you have to do it as a full-time job or pay a lot of attention. And not a lot of us here wants that. We want investments, right? And so for the investments, I found these 2 things. Investments is really either a more fancy savings account, right? So if you think about it, you can put your money, again, risk-free debt. You can put it into either bonds or just the savings account, and they put it into bonds for you, or they provide credit to other banks, etc. But what happens is when you put your money into a savings account, you get risk-free rate. You just get 4% annually, and that percentage can go up and down, but you get it for sure, right? Unless bank collapses and stuff. But that's one approach. So what you do instead of in savings account, you just put your money over time into S&P 500. So everything that is left over from your budgets, from your expenses for this month, you put into your portfolio, right? Bonds and stocks and real estate, whatever that is. That is just a little bit better of a savings account than the banking savings account. There is a different approach. And that's what Warren Buffett uses and other people use. I also like that approach more. It's where you try to view investments as a co-ownership of the company, right? So what you do is you spend a little bit more time really analyzing the company, trying to understand their market, trying to understand their competitors, trying to understand their leadership, and you put more money into them. So you don't over-diversify. You really kind of like playing with, like, let's say 3 or 5 bets at a time. You go really narrow. So your portfolio, again, it's riskier. So you can do it when you're younger or when you have higher income. But it has a potential for higher return. But it's still an investment. That is an investment. Because it's easier to manage. Once you put in money, you don't need to worry about it. You just believe in the company for 20, 30 years from now, such as like Coca-Cola was, 50, 60 years ago, or maybe Apple back in like 2005. Or, there's a lot of these companies that you can think of course, today in hindsight bias, but there's also a lot of companies today that you can think of and you would think, okay, well, like, I don't know, I like Robinhood, right? So I would think, I might be wrong, but I think that Robinhood is so easy to use and people like it and you can do fractional shares and they have all this functionality. So they might be here in 10 years from now and they might have even more money under their assets, assets under management. So they might be a pretty good investment, right? So I buy that share and I take it a little bit more aggressive in that way. All right, so maybe why you all came here. What kind of portfolio can I suggest, right? For everybody who is starting today and they're looking to build their portfolio, what would I suggest doing? And I'll show this graph basically just to make it very visual and then I'll go back. I would put 50% of my money into the US ETFs. I would put 15% into international because I think the US, it's amount of people here. I'm applying for green card soon, so please watch this video.
Don't forget to say thank you.
Yeah, that's right. That's right. I'll wear a costume, a suit. So I do think that the US is an incredibly strong country. They're very strongly positioned. They have enormous amount of resources, natural land. They have 2 oceans on both sides. Maybe a lot of these things you've heard in the news, but I also believe in it. And I see a lot of smart people here still not really wanting to leave, right? They still believe in this country. They still build and they still invest a lot of money in this. So the US has a chance to collapse, just like any other empire, country, big country in the past did. Most likely everything goes to zero, right? We're all going to die at some point. But the US right now is a pretty strongly positioned country. So I would still put 50% in the US, but I would put money into international companies as well. I think India is an incredible market. Because if you look at the demography or demographics of countries, the more people you have, the more resources, the more capital, the more time you get with those people, right? So India has the most people right now in the world, and most likely some of them are going to do an incredible thing. They have a lot of resources, they have a lot of land, etc., etc. So India is a good one. I would stay a little bit away from Europe. It's unclear what's going to happen with it. It's unclear how the ETFs are going to. So you can see and play with, by your beliefs, by geopolitics and things like that. But in the grand scheme of things, international ETFs taking 15% here. Bonds, 20%. Then this is US bonds. I wouldn't buy any other country. Commodities. I actually put 5% for commodities, crypto, and REITs. So the reason why I put commodities and crypto here up to 5%, and I know some people might say, well, it's riskier. I think sometimes you freaking gotta take risks to make money. But also, because the US is in a position where they might actually collapse, right? If this does happen, then having some money in your gold and silver and having some money in crypto that could be used internationally and cross-border, or some country could use it as a safe currency, like El Salvador does. Not a bad idea, right? And then REITs, for those who don't know what REITs are, these are the real estate funds, right? So it's usually the company that has a lot of real estate under management. So they have residential buildings like this one, right? Most likely no single person owns this building. it's usually the company. They have management services, they have many more buildings like this, and that's what REITs are. There's different ways to invest into real estate, but basically you look at this slice as real estate. This is commodities, this is currencies. You can buy Chinese yuan or Swiss franc as well here. So maybe I should have not said crypto, I should have said currencies here. Bonds, international ETFs, and US ETFs. Let me see. Yes, and later on, again, you start easy, you start very simple. And later on, when you accumulate more and more money, you can take, so what you will see over time is that these percentages are going to start shifting, right? So if the US stocks all of a sudden grow 15%, well, now they take more of this pie and you need to rebalance, right? So what happens then as well is that you might take money out of the US and you can put it into other types of investments like angel investments in private equity. You can start owning the real estate. You can do business and things like that, right? So that will become part of your portfolio. So if we go back to this picture, now 2% or 10% or something is going to become, let's say, private equity, right? So investments into other businesses or your own business. So I'm going to go back here. And now, what I want you to do, or those who have Robinhood, raise your hand. Who have Robinhood? Okay. So what I'm going to do right now, I'll show an example. Again, like I think I've done this example last time, and I'll do it again just for those who haven't been here, or maybe I'll be more elaborate about how we do it. But I'll try to set up a few of these things to be purchased automatically from my banking account. So I don't have to think about it. And I will tell you exactly how I think about things when I am trying to build my portfolio, right? So first things first, I need to, I'm not going to be able to. Okay, let's see if it's going to work. So here's my Robinhood, right? Here are things that I don't know how many of you know, but these are tickers. So again, we spoke about this a little bit, right? So when we go to the platform where we can track the prices for different things, for different assets, we will use tickers, right? So we don't have to write the whole company name, we just use the tickers. So these are the different tickers. These are like different initials for different stocks. And you can see a lot of data here. What I've done is I've created this list of all these tickers, right? So you can see all these different assets that I've added here. And what I will do after this class is I will share it with every one of you. So you can go and you can see all this. So you will get this list for free. It's a free platform as well to use. You can see the share price every single day. I know we haven't covered this because we are not going too deep into technical analysis, but that's what people will use for trading, right? But you can also use this, and it's incredibly valuable source of information. I will show you a couple things. So first of all, we can go into bonds for a second. So you will see that the bonds have this BND, TLT, AG, VTAP. So what are the differences? Well, first of all, different bonds, right? So there could be 20-year bond, there could be all bonds together, there could be 10-year bonds, there could be US bonds and international bonds. So all these different bonds would have different tickers. They would have different products, right? So right now I want to look at BND, and I will explain why. So BND, also sometimes it could be exactly the same thing, so such as VOO. You can see at the top here on the top left, it's a Vanguard S&P 500 ETF, right? But then you can go into SPY, and it's SPDR S&P 500 ETF Trust. Those are exactly the same thing by different companies. Okay? So it's almost like trying to decide if you want to use iCloud or Google Cloud. They're technically the same thing. They're cloud where you can save things, but they're just by different companies, right? So sometimes it matters which one you buy, and the way it matters is the volume. The volume is liquidity, like how much people are buying and selling this specific ticker. That will tell you how easy is it for you to get the cash for this stock, right? So here's a BND. And what's this one is actually really nice because it's a total bond market. So it takes all the bonds right? And buys them in increments or like the fractions. And you can see this is the price for this specific ticker. So at some point in the time back in 2020, it was $89 and now it's $72. So you can see it doesn't really move much, but why you buy bonds is because of the dividends. It's the percentage that you get from them. So how do you know how much you're gonna get? Well, you can see this D button here. It will show you the amount. It will show you that it has paid 0.24 cents per share. And so what that means is you take 0.24, you divide that by the price. You divide it by the price on that day. It's a little bit harder to see here. We can zoom in just to that day specifically. So again, this is the D. Here's the day. It was $72.37. And then what you do is you multiply that by 100, and you will get 0.33 percentages. Okay? So that number is the percent yield. So that's how much you get from each share. So why is it so small? Well, the reason is because if you, again, zoom out, you will see that this D happens every single month. So every single month you get dividends. Why is this important? The sooner you get dividends, the sooner you can reinvest them, the more compounding can happen. Because if you only got these dividends at the end of the year, then you have to wait the whole year to get your money and put them back into the stock. And then you have to wait a whole year again. Here, you can put dividends into the stock every month, and next month you will get dividends on your initial stock plus the new one. So the more often you get dividends, the better it is. And so what that means for this percentage is that you have to multiply it by 12. So what you will get is 3.97 or 98 percentage annual yield, right? So every single year from owning this bond, you will get about 4%. And that's, if you think about it, is what you get in your savings accounts today. Because this is a risk-free return of the bonds of the US market. You can also scroll a little bit lower here on the right side. There's a palm tree. So if I lower the sleeve, you will see the 3.77%, right? So that's the dividend yield. Why is this number is a little bit different from the number that we've got? Is because we've calculated the $72.37 only once. What they do is they actually look at all 12 months and they get the right prices, right? So this is an average. If you want the actual number, what you need to do is you need to take this and say plus and go to the previous months and get the price, 73.52, and then 0.236 divided by, again, this number was 73.4, and you would need to do that for all 12 months, right? And that way, you will get, and then you need to basically divide it by, in this case, 2 and multiply by 12. So you will see how the number now came a little bit lower. So it will get to that 3.77%. So that's how you can just look it up, and it will tell you exactly for the past usually 12 months.
Some question here.
Yes.
It's with taxes.
With
you
tax.
calculate with taxes all these numbers.
All of this before tax.
But if we try to now calculate how much we can with inflation, taxes, how many percent is?
How many what?
How many percent it will be?
Percent, yeah.
It's like 1 or 0.01.
No, it's gonna be pretty significant, and the reason why, different assets, they have what's called qualified dividends. These dividends, they have a much lower tax, if sometimes not at all, in the US. So
No.
how do you know?
I know. I mean, we don't pay
Yes.
this, or
Yes, you can. You can do two things. And I can, no, there's a better way to do it. So I have this here. It's going to be basically the very next thing we're going to talk about. But
Wait.
what?
How did you understand that they pay dividends each month but not in the end of the year? I didn't get
I'll explain in a second. I'll come back to the question. So here we spoke about this account types, right? So what happens is that you have these different accounts that you can use in order to avoid taxes or defer them. So there are really two different things here. You can either have your regular account that gets all the taxes, right? And sometimes you get the tax exactly when you sell the share. And I'm going to talk about that in a second in rebalancing. The second one is the tax deferred accounts, which means that you don't pay taxes right now. All of it stays invested. But when you start withdrawing money, you will pay tax, regular income tax or capital gain tax. In this case, it's going to be a regular tax. So what happens there is that the idea is that your income right now is high, and you put some money of it into this tax deferred account. So for example, you've made $150,000 this year, and you put $30,000 of that money into this tax deferred account, 401k or IRA, traditional ones. Now, today, you pay taxes on $120,000. So this $30,000, you don't pay taxes on them today. You put them in, they are invested, and you will pay taxes on them when you withdraw them in your pension. And when you, in your retirement, right? When you are in your retirement, the idea is that you don't make any money. So if you withdraw $100,000, these are the only $100,000 you're going to pay the tax on, which is going to be a lower tax than you would have paid on the same $30,000. So not just that the money stay invested until your retirement, but also in your retirement, you don't have any income, so the taxes are going to be lower. That's one approach. The second approach is that you pay taxes today. It's this one, Roth IRA. You pay taxes today, so you've made $150,000, you've paid taxes, you're left with about $115,000, and you put $6,000, $7,000, $8,000 into the Roth IRA. Why I say those numbers is because country limits how much you can put into these accounts because they're really good. The reason why there's a limit is because whatever you make in these accounts are not taxed at all. No dividends, nothing. Nothing is taxed on your gain. So there are ways to avoid taxes. And this particular account and that one, so the tax deferred or tax-free savings, tax-free investment accounts, they are much better for those portfolios where you need to rebalance often. Let's say every year or every 2 years you want to rebalance your portfolio. Because when you sell the stock, right? So again, if we go back to the chart, if you've made US ETFs go up real high, now you have 70% of US stock. It's too much reliance on the US. You sell 20% to bring this back down to 50. But when you sell it in your regular account, you have to pay taxes on that. Because now you've potentially made money, and they don't care if you're rebalancing or not. All they want to know is give us the taxes. If you sold the stock, like you might have taken your money out. But all you wanted to do is you want to sell some and buy more bonds, for example. If you want to do that more often, you should do it in this tax-deferred, tax-free accounts. Another way to do it, I have this slide here, right? We were supposed to talk about this a little bit later. If you want to do that in your regular taxable income account, you rebalance by putting more money in. Because when you put more money in, you don't pay any taxes. So again, if you had US ETFs, now they're 70%. In order to bring the percent of your portfolio lower, you need to make the whole portfolio bigger, right? And so you put more money into your portfolio and you put it directly into bonds, you put it into international ETFs, and that makes the percentage of the US ETFs smaller again, without selling anything. So that way you avoid taxes in the account, taxable accounts, on the rebalancing. Okay? I hope I've answered that question. Tan, you had another question about the dividends.
Yes.
So you see this platform? It shows you these small little Ds on the bottom. So these are the dates, or you can actually click on it and you can see the dividends have these two different things. They have X date and the payment date. The X date is when your brokerages they look at if you have this stock. And if you have this stock, that means that you will get your dividends on the payment date. That is usually in 2 days from the X date. So you will see these 2 different dates, but if you hold this, it's important to have this stock on the X date so that they know that you actually have this stock. And if you have this stock, they will pay you dividends, right? So it's that simple. And you can see how often they do it on this chart. So if you go into S&P, you will see that they do it once a quarter, right? So they do it in March, they do it in April, then the next time they do it in July. So look, X date was yesterday. So if you had S&P, SPY, yesterday, so for those of you who've set up the Robinhood and purchased SPY, you would get the dividends on 31st of July. So you can see sometimes it's 2 days, sometimes it could be months, could be like 2 months, like they decide when to pay out those dividends. But what's important is this X date. You can sell on the 21st, which is today, you can't sell, but you can sell it on 23rd of June, and they will still pay you dividends because you had that stock on the June 20th.
So I still have 3 months to buy it and to make some money.
To make dividends next time.
It's a good.
Yeah, yes, correct.
That's really good explanation. Thank you.
Yeah, absolutely. So again, we have this list, we have this BND. Let's say this is one of those ETFs that we've decided to buy. So now what I can do is I can go and find this BND stock in my Robinhood, right? So we can see the price of it, 72.88, and we can buy. It asks us how much, but this is going to be a one-time purchase. What I want to do is I want to be buying this every single week or every single month, etc., etc., or every 2 weeks, whatever the cadence is. Again, more often you buy, the more advantage you take of a dollar cost average. You can buy every single day, you can buy every week, etc. I think every week is good for me. So what I do is I choose every week, and I press continue. And now it asks me how much do I want to buy of it. Okay, well, how do I calculate that number? How do I know how much should I buy of BND in order for me to stick to my portfolio, right? Well, the first thing I should do is to budget. Because when I budget, I know how much monthly I have my income over expenses saved. So how much savings do I have in order to put into investments in the first place? Well, let's say I've defined as, $400 I can put into my savings, right? My investments. So then I look at my portfolio here, which is 20%. So for the bonds, it's 20%. And I multiply that by 0.2, which is 20%. So I get $80 a month. I can buy BND stock. If I want, and I do want, and I will tell you this, also buy a different stock of the bonds, right? So if I go into this, it says bonds, but let's go with crypto. If I want to buy Bitcoin and Ethereum and Solana and I want another currency like Swiss franc, well, it still doesn't change the percentage. I still want 20% of bonds, no matter how many different stocks or different currencies I want. I want 20%. So what I can do is I can say, well, inside of that 20% of bonds, do I want 10% of it to be TLT and 10% of BND? Or should it be 15% of BND, 5% of TLT? So you can play, but overall it's 20% of bonds. So you can see it's like fractals, right? You have the whole portfolio, then you have each segment as a whole portfolio, and you can keep dividing it and dividing it. So for example, if you want to buy real estate, well, okay, so real estate is going to be 5% in this case. But which one? Do I buy one apartment in Los Angeles and then one in Florida and then one in Texas? Each one of them costs different money, but in total they should still add up to 5% of my total portfolio, right? So you look at the whole thing and then on each thing as a whole thing again. So in this case, I want BND and I want TLT as two individual things. Okay, well then I go back and I have my budget of $400. It is 20%, but I actually want two different things and I want 50-50 split. So it's $40 that I can put into BND a month. But I said that I actually want to put every week. So I have to divide this by 4. Some of you might say that there is not actually 4 weeks in the month, there is a little bit more than 4 weeks in the month. I'm fine with that. And I will end up investing a little bit more. That's awesome. So all I can put is $10. And that's fine. So I put $10 here. And I say directly from my banking account. Because so in Robinhood, and on most other platforms now, in these big ETFs, there's almost no fees to buy them. Each ETF usually has something called management fee, because there is somebody or something that volatility curve, you can see how much it moves and everything. So if this website doesn't show you, you can just Google BND ETF. What is management fee? Management fee. And you can see this is $290. So what actually expense ratio, yield. Here, year-to-date returns. Let's see, can I find the fee? Okay, performance and fees right here. So this is the page to look up much more information about this specific stock, right? And I think I skipped the fees again here. So they can show you how much the fees are actually every month, 3 months total, year to date. So here they take 2.46% in fees to manage this whole thing, right? Because again, remember, they have to buy a lot of different bonds. They have to build their own portfolio to properly maintain the ratios of all the bonds, to make it similar to what the actual bonds would pay you, et cetera, et cetera. So they take some percentage of that, but usually they show you the returns after those fees. So this returns, and this one, let's see. Not sure what. Let's find out. Net asset value. That's how much it changed, okay? Expense ratio. How do I know if this yield is after fees or before? So you can look up, because a lot of ETFs, they will show you after the fees. So you can see that the published yields like SEC yield or distribution yields are after the fees. That's usually the case, but not always. Sometimes they trick you. But all these big companies, they don't really try to trick you anymore. Like, they don't need that. So with this, you don't need to worry about the ETF fees, and you don't need to worry about the Robinhood fees. So they will try to buy the most they can for you. So then I swipe up, order received, done. This will happen on Monday. So on Monday, they will try to take money out of my banking account. I should make sure that I have more than $10. And they will buy BND. Now I go back and I do TLT, right? And so you actually might see somewhere here, if they show it.
Why not to put once a month?
You can, but the more often you buy, the better dollar cost average you will get. Because if on some week it goes down more, then you will buy that lower, so you will buy a little bit more of that share before it goes back up again next week, right? So maybe I should even consider buying it every single day. So dollar cost average on steroids. So what I wanted to say is that for TLT, I have actually already put in some reoccurring payment. So I don't want to add a new one. What I want to show you is how easy it is to change one that you already have here. So when I go in here, I can see, here's 3 out of 3, all my reoccurring payments. Oh no, I don't have a TLT, I just bought it directly. So here I can see all of my reoccurring payments, right? So I have S&P Y, $50, I have NVIDIA. That was something that we've played last week. So I don't actually intend to do that, but I have it. And so what I can do is I can create a new one. I can search for TLT. I can, let's say, add to basket. Okay. I can look up all the information about them. I can say, wow, this is amazing. So what they've done here is that I can actually, I'm curious how this is going to work. So if I want also the QQQ, I can add it to basket. So now I can buy two things at the same time. I can say every week. What I'm interested in, oh wow. Okay, so they don't let me choose each individual one, but I can add my whole portfolio and say, based on this portfolio, buy $400 of the whole thing, and it will split evenly across all of them, which is very interesting. So I could have, what I could do is I could go back, I could delete this BND, right? So I can edit, I can end, I can create the recurring, I can go TLT, add to basket, I can go BND, add to basket, continue, every week. And if you remember, I had $80 allocated per month, so $20 allocated for bonds every week. So what's going to happen here is you will see, oh no, I can't choose. That's so, okay. So here I can choose how much I want for each stock. So I literally can pull in all of my portfolio here and choose all of those stocks. So if I go back here, I can choose every single one that I want to buy, then allocate them on a percentage basis, and it'll just take care of the whole thing. This is so cool. So now I can continue. I can say from check-in, every week, $20 in total, 10 to TLT, 10 to BNT. Huh? Ah, damn it. Sorry. Here, let me go back. So here, you can see how I can choose how much I want to put into each one of them. And I can choose this one, and then I can just review this whole order. I can basically schedule many different ones, and I can apply the whole thing. This is so cool. Now I have all my bonds done. So let's do the commodities, right? So let's go to the gold, add to basket, silver, add to basket. So these are the two commodities that I want to buy, right? And you can see them here, gold and silver. So now I can continue, but remember, I only need 5%. So $400 multiplied by 0.005, it's $20 a month, which is again $5 a week. So every week I want $2.5. No, I want $5. But $2.5 of each. That's it. I just set up two of them and I can finish the rest. So you can literally start investing from like $1 today.
Can we do it right with you?
Yes. Yeah.
Can you repeat?
Sure. Or we can do it right after. Yeah. Okay. So this is the portfolio, and we can go here into back. I wanna spend just a little bit more time here talking about different things that I put in here, right? So you will see that VO and S&P SPY are the S&P 500. This VTI, also very interesting. It basically is a total stock market. It takes every single company in the stock market and invests into it in a percentage basis, right? So you will find a lot of these products. QQQ is another ETF. What it does, this one takes the biggest technical companies and it invests just into tech. So again, if you want to ever find out what does each one of them do, you can Google first of all. Again, we saw it in the Robinhood. They have a prospectus. Let's take a look at that as well. So here you can see holdings and sector and overview. Here it's loading. So these are the prospectus, and usually each ETF has. This is like an advertisement or like a summary of what this thing is about. It has all the annualized returns, and it has a lot of like 100 pages of information about this thing. A lot of a lot of it, all the year returns and a lot of graphs and charts. And somewhere here, they have holdings. So here, this is the holdings, right? Schedule of investments from September 30th, 2024. I'm sure you can find the newer one. But the idea is this. So automobiles, they have Tesla. How many shares do they have of Tesla? What's the value of that? Next one, beverages. Coca-Cola, Keurig, Monster Beverage, PepsiCo. Biotechnology, broadline retail. So Amazon here, right? Chemicals, commercial. So again, you don't need to think about what companies to buy. In this way, you're basically diversified across the whole market. And that's why here, it's the US ETFs, right? This is the most passive thing you can do. It's the ETFs. Once you got comfortable with this, well, now you can allocate 10% of this portfolio to the individual stocks. Let's say you really deeply understand some industry, biomedical, steel, right? Technology, whatever that is. And you can choose one company or two companies that you truly think are going to be incredible in this industry, and they will change something, or they will innovate, they will produce a new drug, they will make a lot of money. You can put them into your portfolio on an individual basis. But unless you actually have a deep insight about something, just stay diversified in this way. All right, I'm gonna jump back into this. So I had a little bit more realizations, right? So first of all, the demographics. We hear right now always that the world population, the birth rates are actually below in some countries still, not everywhere. They're below a incremental increase in population. So at some point, it's possible that our population starts to decline in the world. If this starts to happen, remember I was talking a lot about demographics in India. The more people we have, the more productive we are. The less people we have, the less productive we are. So we could see all stocks, all assets, everything. So less people we have, less real estate we need. The less people we have, the less food we need. Everything becomes less, less, and less. And usually that spirals down very quickly, right? Because if we can't have more children, we're just gonna collapse in 150 years from now. And so what happens in those cases is that the whole market is gonna start losing anything and everything. And we might be losing jobs, and AI is taking over, or something. We can't really predict all of these things. So we gotta play from the cards that we have so far. The wars, there's a lot of wars happening, and if somebody does decide to do nuclear war, what are we gonna do about it? We can't really do much about it. And I was thinking about this, there's literally just one single company in Netherlands that does the optics that are required for microprocessors, and the microprocessors are required for our CPUs and GPUs and all technology and a lot of energy and a lot of electricity. Just imagine the world without electricity, right? What is going to be the value of a stock market if we don't have electricity? Well, it's going to be 90%, 95% lower than what it is today. So we might as well lose a lot of money there, but we might be living in a very different world by then. Our world is incredibly fragile. So the way I want to close today is enjoy. Enjoy your freaking lives because they're incredible. Enjoy every single day that you have, and try to save money and health to have more beautiful days. But don't let money become your goal that you chase every single day, right? If you set up your passive investments and enjoy your life, it's one of the most incredible gifts you can get. It is as if you're the business owner who is chasing the stock price and not really focused on building the business in the long term. It's somebody who is trying to make a picture that things work, but eventually they just won't. So again, don't try to, run away from everybody in the market and try to be the smartest person ever. Because if you end up doing it and you have the most amount of money, it's still the question, what are you doing with them? It's still always back to, what do you do? What is your goal? How do you enjoy your day? So don't try to chase every single 0.0001% of profits. Know your goals, allocate your funds properly, and stay invested. Thank you, everyone.